meeting, the question for April 2025. We also did something to do with the piecemeal or the stage acquisition, where we said that this whereby the parent company has acquired the control or acquires control in the subsidiary through several purchase of shares. Equally, we did a question as far as that is concerned. In our previous class, we looked on how to prepare the group account whereby we have a disposal of interest. And actually, we say disposal of interest is whereby the parent company has sold some of the shares, or basically all the shares which are held in a subsidiary. So I think we did a question on partial disposal, but because of time, we are going to do another question on that, but not now. During our revision, we're going to do a question on full disposal, because in terms of how we prepare the group accounts, whereby we have a full disposal, I hope you can be able to recall what we said. We account for a subsidiary which has been fully disposed as a discontinued operation. We have to compute its profit or loss before it was disposed, and also the profit or loss arising from the disposal. And actually, we said that one should be recognized as a separate item within the consolidated statement of financial position. So during our revision, automatically we're going to do a question on full disposal. So make sure you remind me on the same during our revision. So today I want us to basically proceed, and we look on this. I think should be the last concept before we look on the group cash flow. I want us to look on what is known as the overseas. Overseas, in other terms, we refer to this as a foreign subsidiary. A foreign subsidiary, and in this case, the standard which is applicable here is International Accounting Standard number 21, IAS 21, overseas, or basically a foreign subsidiary. So first of all, we need to ask ourselves here, what is an overseas, or basically what is a foreign subsidiary? So this basically a subsidiary which is operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which operates in Kenya has acquired a subsidiary which is either operating in Uganda, in TZ, or maybe like in Rwanda. So that particular subsidiary is operating in a different country from the parent company countries of what? Of operation. So such a subsidiary, we refer to it as an overseas, or basically a foreign what? A subsidiary. So therefore, this is basically a subsidiary company, which is operating in a country different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign, or basically overseas what? A subsidiary. Now, in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling. This one using the Rwandan franc. It is obvious that if you are preparing the group account, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statements of the parent company is prepared in Kenyan shillings, and the financial statements of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency. The functional currency. So when talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group accounts using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group accounts is called the presentation currency. On the other hand, we talk about the functional currency. The functional currency, this is basically the currency, the currency of the primary economic environment, the primary economic environment in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you say the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, assets, liabilities, revenue, and expenses of this company, that is the foreign subsidiary, must be translated into Kenyan shillings, which is the presentation what? A currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, items of incomes and expenses, and remember in this case, what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them, they are translated, items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in both of these particular questions for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the assets and liabilities, of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of in asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to translation. This arises due to translation of basically three items. One of which is goodwill. Is goodwill on acquisition. Number two is a profit for the year. And number three, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items, So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items, the goodwill, profit for the year, and the opening net assets of the subsidiary. So let's start with the goodwill. So remember goodwill, this is the difference between the purchase consideration paid by the parent company and the net assets which were acquired. So basically what is important first of all to note here is that when computing the goodwill, first of all we compute the goodwill, or basically we say that goodwill is computed using the fractional currency, the fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using, the goodwill is computed using the fractional or the local currency of the foreign subsidiary subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill, So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. You'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening. O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here, that now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. The value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what you refer to as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease, like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year, to the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill, translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns. The local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary, foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in in local currency, for example, Rwandan franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value there. And then to this, you add the profit for the year. The profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be affected in the income statement of the subsidiary, like a depreciation other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can revalue assets, like maybe item of PP or even things like intangible assets, like maybe Brad or something like that. So if that the foreign subsidiary revalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation at the charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate, the average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember these net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes will be recognized there as part of the other comprehensive incomes. So basically this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of assets, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I'll say for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of asset and liabilities, those of the foreign subsidiary, will be translated using the crossing exchange rate. Crossing exchange rate. So if you can be able to recall that, basically this one is quite simple, quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022, which is the question number 1. Question number one. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay, okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the Securities Exchange. Listed in the Securities Exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we have said even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign subsidiary is in franc. We have non-current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. A group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 3550 million franc. So this company acquired S Limited, and basically this S Limited, remember, we are told is domiciled is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation doc. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is the parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 35.50, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In Part B, also not Part B, rather note 2, we are told at the acquisition date, the carrying value of S Limited net asset was 2,600 million franc, but the fair value was 3,200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3,200 million franc, and the carrying amount of this net asset was 2,600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is the revaluation what? Gain, is the revaluation gain. So, and then you're told the excess in the fair value of the carrying amount was due to an unrecognized branch with a remaining useful life of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a trademark. In other terms, a brand, this is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued, or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand will be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset, within the consolidated statement of financial position is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful life for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation at the charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation at the charge. We take the revaluation gain for the value at which the asset was revalued at. We divide that with the remaining useful life or economic life. And I think we are told the remaining economic or useful life in note number 2 were 5 years. 5 years, we divide that with 5, and then we should multiply that with the proportion of time. the proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is in foreign subsidiary. This is in foreign what? Subsidiary. So this one, this amortization, number one, this one is basically an expense. It's an expense within the consolidated income statement. And number two, this one will be deducted from this. So this one will be deducted from intangible assets. So the value for intangible asset would be 600 minus this one, which is basically 120. So I think we are done with that. Let's move to the other point. So let's move to the other point. So in point number 3, we are told the non-controlling interest in 𝐻 Limited as at the date of acquisition was fair valued at 1450 million franc using the fair value model or the fair value method. So it basically means that in computation of goodwill, we are going to use the full goodwill method. That's why we are given the NCI at fair value. So, and then number 4, we are told as at 31st of December 2021, that is at the end of the year, it was determined that the goodwill arising on acquisition of S was impaired by 10%. That is the impairment loss. Okay. So number 5, we are given the exchange rate. We are told the foreign exchange rate are relevant. So what you must be in a position to do is to interpret those exchange rates. For example, we are given the exchange rate on how many days? We are given 3 exchange rates. On first, at the start of the year, which is the opening, we are also given the closing exchange rate, and then you are given the average. You're given what? The average. So how do we interpret that? For example, the exchange rate here at the start of the year. So it is given up there, you can see franc to 1 Kenya shilling. Franc to 1 Kenya shillings, and the opening is 5. So this means that the opening exchange rate is 5 franc. 5 franc, this one is equal to 1 Kenya shillings. Sasa, yes, that's basically the interpretation of that. That 5 franc is equal to 1 what? Kenya shillings. Sasa, yes. So that's basically what we have. And I think now having that information, we can just go straight to answering our question. Let's just go direct to answering our question. But I think before we do that, we start, basically we're going to start with Roman 1. I think the first thing we need to do is let's compute the goodwill arising from acquisition. And remember, you have said we compute the goodwill arising from acquisition of this subsidiary using the foreign currency. The foreign currency of 𝐻 Limited is franc. We compute that goodwill using franc, and then we are going to translate it into Kenya shilling. In the process of doing that, we are going to determine the exchange gain or loss as required in Roman 1. So let's do that. And basically that will be part of the workings. And then we will be able to use that goodwill, to compute the exchange difference. So remember, in this case, the method we are going to use is the full goodwill method. The full goodwill method. So at the full goodwill method, here we just need to let's just have one column. We are computing this in franc. In franc, the foreign currency, the franc, and the figures are given in million of shillings. So goodwill using the full goodwill method, or we compute the goodwill using the full goodwill method by, number 1, taking the purchase consideration which was paid by the parent company. To this, we add the NCI at fair value. At fair value. Remember, we are computing this using the foreign currency, the local currency, which is franc. So this purchase consideration, which was paid by the parent company, that one is within note number 1. Note number one, which is given in franc, and that is 3550. So we also have this one, NCI at fair value, in note number 3. Note number 3. So the NCI in 𝐻 Limited at the date of acquisition was valued at 1450 million franc. So we add these two values. What do we get? What are we going to get here? Is it 6,000? 6,000 franc? What are we going to get there? Purchase consideration paid by the parent, note 1, 3550, plus the NCI at fair value in note number 3, 1450. That will give us 5,000. That will give us 5,000. 5,000. So then to this, we proceed and we less the fair value of net assets acquired. So in our case, we know at the date the subsidiary company was acquired, the fair value of its net asset, as per the information we have in note number 2, the fair value of its net asset is already given. This one, it was that 200 million franc. That is still in franc. Now, take into account we're using the full goodwill method. We will take 100% of this. We are using a full goodwill method. We take 100% of that. So the goodwill arising from acquisition, the goodwill arising from acquisition is how much? Goodwill arising from acquisition is how much? Yes, the goodwill arising from acquisition is 1,800 million. 1,800 million. It's also important for you to note that this is still in, this is in foreign currency. This one is in franc. Now, having that, I think we can just go straight to part A of that question, part A, and basically we are required to compute the exchange difference, the exchange what? The exchange difference, which is basically again all a loss on translation of two items, net asset and goodwill. So we're going to start by computing the exchange difference on translation of goodwill. On translation of goodwill. Translation of goodwill. Translation of goodwill. Translation of goodwill. So this one is very, very simple. Very, very simple. Provided you can be able to remember the format which I've given you for computing this. If you can be able to remember that format, this one is quite simple. So in this case, we need to have various columns here. The first column here will be for the foreign the local currency of the foreign subsidiary, which is franc. We have the exchange rate, and then we are translating that to Kenyan shillings. And our figures are in million of shillings. And in million of shillings like that. So what we start with here, we start with the goodwill on the date of acquisition. The goodwill on the date of acquisition. So the goodwill on the date of acquisition is this one. That is 1,800. 1,800. So we translate this into Kenyan shillings using which exchange rate? Which exchange rate do we use here? Remember, this is a goodwill on the date of acquisition, 1st January 2021. Is that the case? So we translate this using the opening exchange rate. The opening exchange rate as per note number 5 is 5. And basically that is 5 franc, which is equal to 1 Kenyan shillings. So how do we translate this into Kenyan shillings? Remember this is franc. This is 1,800 million, sorry, 1,800 million franc. We want to translate that into Kenyan shillings like that. So basically we need to cross multiply, then we divide. So we take 18 times 1 into divided by 5. In other terms, what is important for you to note here, when translating, in translating franc into Kenyan shillings, you'll take the figure which is in franc, you divide that with the exchange rate. Like in this case, 1,800 is in franc. To translate that into Kenyan shillings, you divide that with the exchange rate. If you know that now, it becomes much simpler. Yes, because you'll be taking all the figures in franc to divide to translate them into Kenyan shillings. You divide that with the respective exchange rate. So we will divide that with 500. So we take this divided by 5, not 500, sorry, by 5. That will give us what? That will give us what? We try to hurry up. We try to hurry up. So that one will give us 360. That one will give us 360. And then out to this, we have said we need to less the impairment loss. The impairment loss. So the impairment loss, we are given that information in note number 4. Note 4, we are told as at 31st of December 2021, it was determined that the goodwill on acquisition of S was 10% impaired. So this goodwill was 10%. In there, 10% of this is 180. 180. So first of all, we need, this is an item of expense. Being an item of expense, we will translate that into Kenyan shillings using the average exchange rate. The average exchange rate, as per note number 5, is what? Is 4. Is 4. Is 4. So we take this divided by 4. What do we get? 180 divided by 4. That will give us what? That will give us 45. 45. Then what we do, we take, remember this one should reduce the value for goodwill. So what you do, you leave 2 lines there. And then we will have the value for goodwill at the end of the year. That is on 31st of December 2021. So this minus that basically that will give us what? 1800 minus 180. That one will give us 1620. So that's the value for goodwill at the end of the year in foreign currency, in functional currency. Sasa? Yes. Now, before we proceed to determine the exchange difference, which is a gain or a loss, first of all, get the difference between these two values. Write that value here. Write that value there. Oh, sorry. So this one should be 6. The average is 6, not 4. The average is 6. Yes, thank you for that. The average is 6, not 4. The average is 6. So this one will be 30. That one will be 30. Is that the case? Yes, 180 divided by 6 is 30. Is 30. The average is 6. Yes. So we get the difference between this, which will give us 330. 330 equally, ensure you have a line here. Then what we do, we translate this goodwill at the end of the year into Kenyan shillings using the closing exchange rate. The closing exchange rate is what? Is 4. So we take this divided by 4, and that now will give us the value for goodwill at the end of the year in Kenyan shillings divided by 4. That will give us what? 405. Now then we compare these two values here. We compare those two values there. We determine we have an increase or a decrease from 330 to 405. What is that? That one is automatically an increase. Is automatically an increase. An increase of what? An increase of 75. So being an increase, we refer to that as the exchange gain. As the exchange what? Gain. And basically, I'll say that this one within our consolidated statement of profit or loss is part of other comprehensive income. Is part of other comprehensive income. So basically, that's how we compute the translation or the exchange difference, which is the exchange gain or loss arising from translation of goodwill. Arising from translation of goodwill. So then, still in Roman 1, we need to compute the exchange difference, which is gain or loss, which arises on translation of net assets. Translation of net worth, asset. Translation of net assets. Translation of net assets. So we need to have the same format here. The local currency or the functional currency of the foreign subsidiary, the rate, and the presentation currency, which is Kenyan shillings. So here we start with the opening net assets. So the opening net assets is what we have here. So we know that at the date the subsidiary was acquired, it revalued its net assets, and the net asset of the foreign subsidiary had a value of what? 32. So that is the opening net assets. The opening net asset of the foreign subsidiary. So we need to translate that into Kenyan shillings using the opening exchange rate. The opening exchange rate is 5. This one. The opening exchange rate. The opening exchange rate. That will give us what? 32 divided by 5. So which will give us what? 6. I'm getting 640. Are you getting 640? Yes, 640. Then to this we have said we add the adjusted profit for the year. The profit for the year of the foreign subsidiary. And basically that one should be the adjusted one. The adjusted one. So let's go to the income statement of S Limited, which is a foreign subsidiary. From the income statement of S, how much was its profit for the year? Its profit for the year is 1,500. Is 1,500. 1,500. I hope you can be able to see that. From the income statement of S, its profit for the year, is that 1,500? 1,500? Yes. Now, I've said you need to check whether this foreign subsidiary that is S, whether it had something like depreciation undercharge, depreciation overcharge, maybe something like amortization, which was not yet accounted for. So in our case, what we have is this amortization. Remember, S Limited didn't account for this revaluation of asset. It never accounted for this amount. It equally never accounted for this what? Amortization. So if this amortization was accounted for, automatically that one was supposed to be deducted in arriving at this what? Profit. So we deduct that amortization from that profit for the year. That will give us what? That will give us 1,380. Is that the case? 1,380. 1,380. Are you getting 1,380? 1,380. 1,380. I'm not getting answers today. I'm not getting answers. I'm not getting answers. Karaja, I need to get answers. Peter, I need to get the answers. Once you get the answer, type it in the chat box. Type the answer in the chat box. Type the answer in the chat box. Yes. Now, in this case, we have said that this being the profit for the year, we translate it into presentation currency using the average exchange rate. The average exchange rate in our case is what? A6. A6. So we take 1,380. 1,380 divided by 6. 1,380 divided by 6. Divided by 6. That will give us what? That will give us to 30. So then what we need to do, make sure you leave 2 lines here. And then we have the net asset, the crossing net asset, the crossing net assets. The crossing net asset will be this plus this, which will give us 4580. 4580. And actually, this one should always reconcile. This one should always reconcile with the net asset of the subsidiary at the end of the year. Remember how we compute the net asset of a subsidiary. We said you can either take asset minus liabilities or equity. We said in group accounts, we compute the net asset as the share capital plus reserves. So if we go to the statement of financial position of this company, that is S, what is the value of its net asset, which should be the share capital plus reserves? So the net asset of S at the end of the year, which is the share capital plus the share capital plus reserves. Can you see that figure? I can see that as a figure of 41. Is that the figure? 41. The share capital plus the reserves. Yes, you can see it's not reconciling with this. Reason being that there are a number of items which our company had not accounted for. This company revalued the asset, but never accounted for that. Remember, if S Limited had accounted for this amount of 600, this was supposed to be accounted for as a revaluation reserve. Being a revaluation reserve, it was supposed to be included here. The company was supposed to add 600. And then the profit for this is also part of this. Profit for this is part of this. So the company was supposed to deduct or to have accounted for this as an expense. Was it accounted for? No. So that 120 should be deducted from that value there. And if you work out that, it should give us this value there. It should give us that value. So the reason why those two figures are not reconciling this and this is because our company had not accounted for those two items. If you work out that, is it now reconciling? Is it reconciling? Yes, it is reconciling. Now, what we need to do then, we translate this into presentation currency using the crossing exchange rate. Using the crossing exchange rate, 4580 divided by 4. That will give us 1145. 1145. 1145. So then what we need to do is basically we add these two values, which will give us 870. And then we compare this and this. We compare that with that. We determine, do we have an increase or a decrease? I can see we have an increase. An increase is an exchange gain. Is an exchange gain. Is an exchange gain, of which this one will be part of other comprehensive incomes. So which I'm told is 2 275. Yes, in our case, we are done. We are basically done. That is what was required as far as that question says, that is part A of that question is concerned. By doing that, you get 6 marks. I want us then we move to part B of the question, which is very, very simple. Very, very simple. You'll be able to see that. Part B, what are we required to do? We are required to prepare the consolidated statement of a profit or loss, which is basically for the year which ended 31st of December 2021. 31st of December 2021. Now, how do we prepare this one? We prepare that by consolidating, by basically combining similar items of revenue and expenses, that of the parent, that of the subsidiary. But we have said before we do that, we have to translate items of revenue and expenses of this foreign subsidiary into Kenya shillings. We have said to translate these, we always use the average exchange rate. The average exchange rate. So let's just do that translation here as we prepare this. So this would be in Kenyan shillings, and our figures are in million of shillings. So we go back to the statement of profit or loss for individual companies, which is given, I think, below paragraph 2 of our question. We take the revenue of the parent, which is 2145, plus the revenue of the subsidiary, which is S, that is 10,500. But because this one is in franc, we need to translate that into Kenyan shillings by dividing that with the average exchange rate. Dividing that with the average exchange rate. So the average exchange rate, as per the information we have in note number 6, is note number 5. The average exchange rate is 6. So do we have any adjustment here? No, because the only adjustment affecting revenue is intergroup trading. Do we have any amount of intergroup trading? No. So we just need to get the final values here. 10,500 divided by 6 plus 2145. I'm getting 38.95. 38.95. So then from there we check the cost of our sales. Cost of our sales, we do the same. We take that of the parent, 915, plus that of the foreign subsidiary, which is 63. We divide that with the average exchange rate, which is 6. Do we have any adjustment here? No, because we know that the only adjustment which is effected here is adjustment for ungauged profit, depreciation other charge, which we don't have. We don't have any of those adjustments. So just an issue of translating 63 divided by 6, 1050 plus 915. So which will give us 1965. So we left that from the revenue, we get the gross profit. We get the gross profit. The gross profit. The gross profit would be how much? The gross profit. The gross profit, I'm getting, yes, I'm getting 13 what? 90. So then from there we have the distribution cost. The distribution cost, in all questions for group account, we said these items do not have any adjustments. Just maybe translating the distribution cost of the subsidiary into what? Into the presentation currency, which is basically 750. I will equally divide that with 6. I will equally divide that with 6. And I hope you can see what we are translating is only this of the foreign subsidiary, not the total. Not the total. 750 divided by 6 plus 150. So that will give us 275. Then from there we have administrative expenses. Now for the administrative expenses, we have that of the parent, which is 345 plus 1350. This one we divide it with 6. Now in this case, there are 2 other items we need to capture here. One, we have what? This company here, we have this amortization. This amortization, remember this amortization was not accounted for. We said amortization, that one should be included as part of administrative. And because it is still in franc, we add it to this. We are going to translate all this using the average. All of them are items of expenses. The other item we also need to capture here is this impairment loss. The impairment loss, this one. So let's add it here still in franc. That is 180. Sasa? Yes, you can see this is in franc, this is in franc, this is in franc. We get the total administrative expense of the subsidiary, and then we divide that with the average. We divide that with the average. Sasa? Yes. So we take 1350 plus 120 plus 180. We divide that with 6. 275 plus 345. And in that case, I'm getting 620. I'm getting 620. 620. I hope that is what you're getting. Is that what you're getting? Is that what you're getting? Yes. So then we get the operating profit. So this minus the two expenses. 1930 minus 275 minus 620. So I'm getting operating profit of 1035. Can you see how simple this is? Can you see how this simple this is? This one is very, very simple. And actually, this is a question they keep on repeating. And this question, I think, was still tested some time back. They keep on repeating this question here. So this is this kind of the area, which is very, very important, which is very, very simple. That is. So then below that, we have investment income. Investment income, we take that of the parent, which is basically 15, and the subsidiary 0. So nothing need to be translated there. And then we have the finance cost. Finance cost, we take that of the parent plus that of the subsidiary 150, divide that with 6. And no adjustment here. So we take 150 divided by 6, 25 plus that which will give us 55. Yes, so then we get the profit before tax. The profit before tax, which is this. So this investment income, sorry, should be added because this is an income. This one to be deducted. So 1035 plus 15 minus 55. So that will give us 995. 995. And then out to this we less the income tax expense. So the income tax expense also is another an item which do not have any adjustment. Although in this question there is nothing which was to be adjusted except the administrative expenses. So 165 plus 450, we divide that with 6. 450 divided by 6 plus 165, which will give us to what? 240. And then we get the profit for the year. The profit for the year. So this will give us 755. So to this then, finally, I hope you can see there is nothing else which is given in that statement of profit or loss. But here, we must proceed and we add something called the other comprehensive incomes. The other comprehensive income. So what do we recognize here as other comprehensive incomes? So these exchange gains. The exchange gain on translation of goodwill, exchange gain on translation of net asset. So the exchange gain on translation of goodwill, which is 75, and also on translation of net assets, which is 275. And we get what? We get the total comprehensive incomes. We get the total comprehensive incomes. So I'm getting 11 what? I'm getting that 1105. Are you getting that value? Yes, yes. So basically that is it. That was required in part B of that question. And basically these are the items which are marked in that question. So by doing such, the marks allocated there were 6. So let's move to the other part of the question. The other part of the question, and that is the statement of the statement, that is part C, the consolidated statement of financial position as at 31st of December 2021. 31st of December 2021. Yes. So how do we prepare this one? We prepare this basically by combining, by adding together similar items of assets and liabilities, that of P, that of S. But now, remember the assets and liabilities of the foreign subsidiary are in franc. We translate them into presentation currency using the crossing exchange rate. The crossing exchange rate. That is what is important here. So we will start with an non-current asset, and remember our figures here will be in Kenyan shillings. In Kenyan shillings here. So we start with the non-current assets. The non-current assets. So for the non-current assets, we have the PPE, property, plant, and equipment. So we will take that of the parent, which is 4850, plus that of the S Limited, which is 7,000. And then now we divide this with the crossing exchange rate. The crossing exchange rate as per note number 5 is 4. So no adjustment here because there was no item of PP which was revalued. So we just get the final value. So I'm getting what? I'm getting 66. I'm getting 66. Are you getting 66? Are you getting 66? Yes, 66. So down there, what we have is the investment in S. The investment in S is automatically the purchase consideration, which was paid by the parent company in acquiring shares of S. I hope you can be able to remember that amount. It was here, this one. It was 3550, but now this amount, this one is in franc. Automatically, this one was translated into Kenyan shillings at the date the purchase consideration was paid. The purchase consideration, this one was paid at the start. So this one was translated into Kenyan shillings using the opening exchange rate, which is 5. So if you divide that with 5, that will give you what? 710. So, but do we include that amount here? No, we don't include the purchase consideration paid in acquiring a subsidiary here. What we include instead, we include the goodwill. The goodwill on acquisition of S. And the goodwill on acquisition of S at the end of the year is basically what we have here. This goodwill, which has already been translated in Kenyan shillings. This one, 405. That one, Sasa? Yes. So the other item which you must also remember to include here, because we don't have any other non-current asset, remember the subsidiary revalued this brand. We can just include it here as unrecognized brand. So the brand was valued at an amount of 600, but it was supposed to be amortized with an amount of how much? 120. So we left 120. But now, remember these figures are in franc. That now will give us the unrecognized brand at the end of the year. So which will be 480. We need to translate that using the crossing exchange rate. I hope you can see what I've done. 600 minus impairment loss. That will give us 480, which will be the value for unrecognized brand at the end of the year. But still in franc, we need to translate that using the crossing exchange rate, which now will be 120, because it is 480 divided by 4, divided by 120. So we move, and then we record the non-current asset. Sorry, the current asset, that is. I think we can do away with this one. Yes, so we record the current assets now. The current asset. So for the current asset, we have inventory. We take that of the parent, which is 1030, plus that of S, which is basically 24. We divide this with 4. That will give us 600. That will give us 1630. We have trade receivables. trade receivables, we take 970 plus 1960 divided by 4. Yes. So no adjustment here. You can see we don't have any adjustment. I'm told it's 1460. I'm told that is 1460 by Mercy. By Mercy, I hope that is correct. I hope that is correct. Okay. So then from there we have the cash and cash equivalents. So we do the same. We take 4 for 10 plus 540 divided by 4. No adjustment still. Yes, what are you getting? Yes, 545 like that. 545. Okay. So basically we are done with that. We said in this question, never bother yourself getting totals. What is marked are these. These are the entries which are marked. Never bother yourself getting totals. So then we move and basically we record what? We record equity. So we start with the ordinary share capital. So for the ordinary share capital, basically we know that we only include the share capital of the parent. The share capital of the parent, which is 15. So below that we have a share premium. Share premium will also include that of the parent company only, which is 500. Below that, what do we have? We have the retained earnings. The retained earnings, we say no need of computing that. Just that one is just leave it. Don't bother yourself computing that. But now, in these questions, because we may come across a question maybe in the topic when covering cash flow, you see these particular exchange differences which you have recognized here. When we have those exchange differences, this one. So we compute the exchange difference, which is basically attributable to the parent company, and we recognize it here as a component of equity. Basically, we refer to that as currency translation reserve. Currency translation reserve. The currency translation reserve for the parent company. So to compute the currency translation difference for the parent, we basically get this total. This will give us a total of what? This will give us a total of 75 plus 275. That will give us what? Is it 350? Yes, and then we compute that of the parent company. That of the parent company will be equal to 80%. That one will be equal to 80% for the parent. That's that? Yes. For the parent, that which we include here. That's why you can see even share capital, share premium, we are including that of the parent. 80% of that will be 280. That one should be recognized there as a component of equity. So then in that case, automatically we can't be able to get the total. So equally below here, there is something else we compute. No need of equally computing this one. Then NCI, we just leave it. And then now from there, we proceed to record the liabilities. We record the liabilities. We start with the non-current liabilities. So for the non-current liabilities, we have 10% boards. 10% boards. I will take that of the parent, which is 820 plus 2640. But this one, remember, we translate items of asset and liabilities using the crossing. Items of asset and liabilities. The crossing is 4. The crossing is 4. That will give us what? 660 plus the 820. Yes, that will give us 14. That one will give us 1480. 1480. So then from there we have the deferred tax. The deferred tax. So the deferred tax will do the same, 740 plus 2160, divide that with 4, and then we get the final value here. What would be the final value? The final value, the final value. Is that what you're getting? Yes. So then next we have the current liabilities. The current liabilities. So for the current liabilities, we will start with the trade payables. We will start with the trade payables. So for the trade payables, we will take 1330 plus 2240. We divide that with 4, and then current tax. Current tax, we take 520 plus 760, divided that with 4. Divided that with 4. So that's basically how we get the final values there. So 1890, I presume that is payables. What about the current tax? What about the current tax? The current tax is what? Is 710. Is 7 what? 10. 710, 710, 710. So basically that will be the total equity and what? And liabilities. Total equity and liabilities. So no need of getting the total because there are 2 items you have not computed up there. And that question, if you do it like that, even if you have not computed the NCI, even if you have not computed the group retained earnings, basically that is the question will be able to score all the marks, all the marks, all the marks. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So 15 out of how many marks? Out of 8. So automatically take into account we have 8 marks, 15 ticks. So this how such a question is marked. For any 8 at 1, you just need to get 8 items correct. If you just get 8 items correct, you have all the 8 marks. You have all the 8 marks, all the 8 marks. And I think that should also apply here. Any 6 at 1, any 6 correct item, you get 1 mark each. By the end of the day, you get your what? Your 6 marks, your 6 marks. So that is it. That's basically how we do the translation and also the consolidation. Can you see how simple this is? Yes, this is very, very simple. This is a question, I think, which has been repeated for a number of times. This question was examined some time back, but they decided to repeat it in this particular sitting here. There is a question I want to give as an assignment. I think the question for which sitting? Yes, this one for December 2023. You attempt this question December 2023, which is basically question number 1. You'll be able to see it's just the same. Although this question, there was an adjustment affecting I think payables, but just attempt it. Maybe during our revision, we will be able to see whether we will get some time and look on that question. Sasa, but that is it about regarding the foreign or the overseas subsidiary. It basically means that once now we meet next week, we are basically finalizing on this. We are finalizing on this because now what is remaining is on group cash flow, or basically the consolidated cash flow. That is what is remaining. But automatically we will be able to come back to this topic during our revision, because remember I said that this is a very serious area. If you check on the past papers, you'll be able to see mostly there are 2 questions which come from this topic. 2 questions. A question for group cash flow, another question for group account. Like the paper which was there last meeting, how many questions were there? I think last meeting I think there was just one question. Which was very simple. Actually, that paper for last meeting It was one of the easiest paper which has ever been tested. There was one question, but if you check on the other paper for, I think, December 2024, there were two questions. There was a question for group accounts, I think piecemeal acquisition, and there was a question on cash flow. There was a question on group cash flow. If you check on the paper for August 2024, there were still two questions, group cash flow and another question. So that's why I'm saying that these are very, very common area in the exam. Either you get two questions of 20 marks or basically maybe one question. But mostly, I expect two questions this sitting because you can see last time there was no question on cash flow. I expect that that will be tested this time, and also another question for group account. Sasa, yes. So for today, we're going to stop at that point. Make sure you attempt that question for December 2023. Once we meet next week, we are finalizing on this. Basically by looking on discussing what is the group cash flow, and then from there we will be able to see what is remaining, such that by 21st we should be done with this and we start officially our revision. So let's stop at that point for today. Have a nice weekend. See you next week on Tuesday.
Will respond to this. Can I start on? Can you hear me? I hope you can hear me. I hope you can hear me. On our first question, we can start on our first question. So we can now our first question. Our first question on partnership. So we can start on our first question, that is on partnership. That is August 2023. August 2023. That is question 4C. August 2023. On partnership, August 2023. We have it as question 4C. Question 4C. August 2023, question 4C. Are we ready? If we are ready, then we respond with a yes. If we are ready, then we respond with a yes. If we are ready, then we respond with a yes. If we are ready, then we respond with a yes. Are we ready? So they told Mambo, Motor, and Motorcar. Mambo, Motor, and Motorcar are in partnership, sharing what we call the profit and losses in the ratio of 2:1:1. So we have three partners. The first one is called Mambo. The first one is called Mambo. The second one is called Motor. And the third one is called Motorcar. It's called Motorcar. So they're sharing profit in the ratio of 2:1:1, implying that Mambo is getting a ratio of 2/4, which is equivalent to a half. Motor gets a quarter, and Motorcar gets a quarter. This is the profit and loss sharing ratio. Is that clear? That is the profit and loss sharing ratio. Are we together? That is basically the profit and loss sharing ratio. We respond with a yes if that's okay. We respond with a yes if that is okay. So then the examiner tells us the statement of profit and loss, that their statement of profit and loss, their statement for profit and loss, their statement for profit and loss for the year ended at 1st December 2022 was as follows. So we have the gross profit, that is a figure of 4.2 million. We have sale of what we call the delivery van, a figure of 1.4 million. Then we have expenses altogether. On the income, one of the fundamental questions that you ask on the income part, you ask whether the income is taxable or the income is non-taxable. So when you look at the two income, number one is a gross profit. Is that a taxable income or not a taxable income? When you look at the gross profit, is that a taxable income or not a taxable income? When you look at the gross profit, is that a taxable income or not a taxable income? The gross profit, is that a taxable income or not a taxable income? Is that a taxable income or not a taxable income? Yes to mean taxable or non-taxable. That's a taxable income. Then the second type of income is sale of what we call a delivery van, sale of what we call delivery van proceed, the figure of 1.4. A figure of 1.4. Is that a taxable income or non-taxable income? Is that a taxable income or a non-taxable income? Is that a taxable income or a non-taxable income? Or a non-taxable income? Sale of delivery van proceeds. Proceeds from fixed asset. Joy, what do you say about proceeds from fixed asset? Proceeds from fixed asset. What did you basically say about proceeds from fixed asset? That should be non-taxable income. Note that that is a non-taxable income. Together, team, that is a non-taxable income. Are we in agreement that that is a non-taxable income? So proceed of delivery van, sale of delivery van proceed, that is non-taxable income. Why? Because those are basically proceeds from what we call a fixed asset. So that should be a non-taxable income. Is that noted? We note that with the yes, then we proceed. So then we go to the expenses. we go to the expenses. On expenses, we need to understand the concept of allowable expense and the concept of non-allowable expense. That we need to understand the concept of allowable expense and the concept of non-allowable expense. We did say that allowable expenses, these are expenses that can be deducted against taxable income. However, for non-allowable expenses or disallowable expenses, these are expenses that cannot be deducted against a taxable income. Number one is advertisement. Is advertisement allowable or non-allowable expense? Unless it's stated that that was advertising in relation to capital expenditure, but advertising on its own, that should be allowable expense. Then the next we have what's called depreciation. We have depreciation. Depreciation is non-allowable expense. Then you have rent and rates. That should be allowable expense. We have the next, that is general expenses. General expenses. General expenses. Those are not bad debts. We say general expenses. That should be allowable. So then we have the next, what we call general expenses should be allowable unless stated, unless something contrary is said. Then we have the value added tax. That is the VAT, value added tax. That is, all forms of taxes are outrightly non-allowable expenses. So then we're being told that bad debts, we have the bad debts, unless non-allowable, unless what's going on. If they represent what's called a general provision, are we together? Then they're non-allowable together. However, if the bad debts, look at, we can have two bad debts together. We can have bad debts in relation to revenue item that would be allowable. I have a bad debt in relation to what we call fixed asset that is non-allowable. In relation to the fixed asset that should be non-allowable. Are we together? Or sometimes you can be told that bad debts are in relation to a general provision. If the bad debts are basically in relation to a general provision, then that should be non-allowable expense together. So that is subject to additional information. As it is, we're subjected to additional information. What if you just told bad debt and there's no additional information? How would you treat it? If you're told bad debts, there's nothing like general bad debts, but I've just said bad debts and there's not an additional information. How would you treat it? If it's bad debts and there's not an additional information, how would you treat the bad debts? It would be allowable. That would definitely be allowable. So then we have the next is purchase of furniture. We call it purchase of furniture. Is that allowable expense or a non-allowable expense? That is a non-allowable expense. Then you have salaries and wages. We have salaries and wages. That should be allowable expense. Then you have what we call the legal fees. Legal fee.
Ni arambuka nindi sarawambu. Ukulingana gatoko he undu njikwirito.
Legal fee. Subject to, but additional information. However, if there's no additional information, if there's no, let me mute everybody. If there's no additional information, then we treat it as allowable. If there's not an additional information, then we treat it as allowable expense. If there's not an additional information, then we treat it as allowable expense. I'm basically saying that if there's not an additional information, then we treat it as allowable expense. If we have legal fees, as for example, when you look at the examination for the CAMS and the TD, they normally provide legal fees without additional information. So if you have a legal fee without an additional information, then basically we treat it as what you call as allowable expense. But most of the questions that pertains to PFT, you realize that you'll be given what you call an additional information. You realize that you'll be given an additional information. You realize that you'll be given an additional information. So that is subject to the additional information. So then we have what we call goodwill written off. Goodwill written off. We have what we call the goodwill written off. That is a non-allowable expense. Then lastly, we have what we call interest on capital. Lastly, we have what we call interest on capital. Lastly, we have what we call interest on capital. Remember, this is partnership. Salaries to partners, commissions to partners, interest on capital, those are non-allowable expense. So we are going to add them back because they are included in the P&L. So if you look at that P&L, this accountant basically said that this partnership was basically making what? Making a profit of $1,597,000. $1,597,000. So then on additional information, the examiner tells us that advertisement expense includes shillings 120 spent on acquisition of neon sign. That advertisement expense includes shillings 120 spent on acquisition of a neon sign. Spent on acquisition of a neon sign. How do you treat amount that is spent on non-allowable? And we do what? We claim what we call investment allowance on that figure. We claim what we call the investment allowance on that figure. So then we are given the breakdown. We are provided the breakdown. So being told that general expenses comprised of the following. General expenses comprised of the following. So we are called partners NDS party. Partners NDS party on the general. That should be non-allowable. Any payments to partner, that should be non-allowable expense. So that is non-allowable expense. That is non-allowable expense. So the next one we're being told, staff catering services. Staff catering services. Staff catering services. Staff catering services. How to treat the staff catering services? The staff catering services. Are those allowable expense or non-allowable? That should be an allowable expense. So then we have the last one, what we call embezzlement by the cashier. Embezzlement by the cashier, the figure is 210. Embezzlement by the cashier, that should be non-allowable expense. Additional information number three, the examiner tells us that budgets represent a general provision made for the year. All provisions in taxation, how do you treat all provision? That budgets represents a general provision made for the year. Then that makes that budgets to be non-allowable expense. So then we proceed to the next. We are told that we're being told that legal fees comprise of the following. That the legal fee comprise of the following. Legal fee comprise of the following. So we're being told that parking fines. How do you treat the parking fines? That should be non-allowable expense. Then the next is settling dispute with customer. Legal fee in relation to customers and debtors. That should be allowable legal fee. Then the last one on that additional information, we have appeal on tax assessment. Appeal on the tax assessment. And that should be non-allowable expense. Then lastly, we are being told that investment allowance were agreed at a figure of 380 with the Commissioner of Domestic Tax. This is where I want to ask a question. Are we still going to claim on furniture and neon sign? If you're told that investment allowance was agreed by the Commissioner at a figure of 380, are we still going to claim? Are we still going to claim? We are not going to claim because they are accounted for in the figure 3, in the figure 380. So the examiner tells us that required, prepare what we call the adjusted taxable profit or loss for partnership for the year ended at 1st December 2022. And number 2, allocation of what we call the taxable profit or loss in CA above. So we start with the first one. Which method are we going to apply in order to determine the adjusted taxable income? Which method are we going to apply to basically determine the adjusted taxable income? We are going to use the net profit method because we've been provided with accounting profit. We have been provided with the accounting profit. Because you have been provided with the accounting profit. So the name of the partnership is basically Mambo, Motor, and Motor Car. So say Mambo, we call it Motor, and Motor Car, we call it partnership, and Motor Car partnership. So we have what's called adjusted taxable, we say adjusted taxable profit or loss, for which year? We call it for 2022. So I'm teaching you example. When you look at this, I'm now basically teaching you example. I'll take it now. So does this thing account for anything? Writing this, do you think it accounts for anything? It doesn't account for anything. So don't waste time making it more beautiful. Don't waste time making that beautiful altogether. There's no need altogether. There is no need. So you just make it that. Then you have this. What are we adjusting? So we call it accounting profit. We call it provided. So accounting profit provided. So what is the figure for that accounting profit that is provided? That's 1,597,597, 1,597, 1,597, 1,597. Just a minute, I attempt. We teach exam, basically just teach how to approach exam. There's not a mark that is provided for this, but though it's very important altogether. But there's no mark that is provided for this. So then we add back, we say we add back, what we call we call it non-allowable expenses in P&L, taxable and taxable income, what we call taxable income not in P&L, and taxable income not in P&L. I think I've said this over and over. I have spoken about this over and over. When you come to exam, what do you say? Because there's no mark that will be given here. But your role as I teach is to basically understand what you need to add back. Are we together? Just simply write add back. Don't waste your time. Write add back and you start your entries. Don't waste time. So then we go to that. We have depreciation. We have what we call depreciation. So this is where you begin to get marks. So depreciation is a figure of 148. Depreciation is a figure of 148. I have what we call value. added tax. What is the figure for the value added tax? What is the figure for the value added tax? What is the figure for the value added tax? You gave me that. The figure for the value added tax. It's better when you give Molimo. Figure is 150. The figure should be 150. The figure should be 150. We have what you call purchase of furniture. What you call purchase of what you call furniture. Purchase of furniture. Purchase of furniture, that should be a figure of 620. We have goodwill written off. Goodwill written off. Goodwill written off. 225. We have it as 225. Goodwill written off 225. Then we have interest. Interest on capital. Again, I advise you. Are we together? So when you have this interest on capital, sometimes some people combine the figure. Sometimes some people combine the figure. Sometimes the people combine the figure. Are we together? But I advise you not to combine the figure. Separate for each partner. Separate for each partners. Just call it mambo. Call it mambo. And have what you call motto. And have motto. So mambo is 80. This is 140. This is 140. And I was basically saying, you look at what I was telling you. I was saying that instead of adding this, essentially you should basically score when you add it. But it depends sometimes on the person marking your paper. Let's say, for example, these entries you combined, and that person did not factor, or maybe is marking in an array, and there are 2 marks there. It simply looks at those 2 figures are separate, and you lose it. So it's better that you separate. So for me, I would want my students to separate. If there's interest on capital, don't write it as a whole. Though you essentially you should basically get that figure when you write it as a whole. But I kindly advise that you separate this figure. Douglas, are we together? I kindly advise that we separate the figure. I kindly advise that you separate. In an exam, you separate that figure. So then we proceed to the next. We go to this additional information. Advertisement include what we call 120 spent on acquisition of neon signs. So then we have what we call a neon sign. I have neon sign. I have neon sign. Neon sign is a figure of 120. Neon sign is a figure of 120. Then we have partners. Partners India party. India party, that should be a figure of 150. A figure of 150. Then you have what you call embezzlement. Embezzlement, I hope you can still see. Embezzlement, we call it by cashier. Embezzlement by the cashier. So embezzlement by the cashier, we have a figure of 210. Can you still see there? Embezzlement by the cashier, that is perfect. If we can still see that, perfect. If we can still see that, then that should be perfect. Then that should be perfect. So then we get to the next. We are being told that budgets represents general provision. Budgets represent what we call, we still have a space there. We'll call it general provision. What is the figure for the general provision? So budgets represents, that should be 250. Is that 250? Is that 250? Is that 250? Perfect. Then I come to this at the end. 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 We're told that legal fee comprise of the following. So we have parking fines. We call it parking fines. Parking fines. Parking fines is a figure of 130. 130. Parking fine is a figure of 130. Then appeal. We have appeal on what we call on a tax assessment. Appeal on what we call on a tax assessment. That is a figure of 210. Appeal on a tax assessment. Is there any entry that that needs to be added back that we've not added? Is there any entry that needs to be less that needs to be added back that we have not added? Is there any entry that needs to be added back that has not been added? So in an exam scenario, because we are on block, in an exam scenario, what do I do? In an exam scenario, what should I do if I have this as a student? Should I go on to add these items? Or what should I do? Don't go to add these items. Just go and make this entry. So you say less what you call non-taxable, because that will not give you, getting that entry will not give you anything. Less non-taxable, we call it the non-taxable income. We call it the non-taxable income. Income in P&L. In P&L, comma, we have what we call the investment income. Income in the P&L. And what we call allowable expense. We call it the allowable expense, not in P&L. Not in the P&L. Not in the P&L. For a learner, what do you need to do? You simply need to learn less, only less. Don't waste your time on that. You simply need to talk about less altogether. So what do I do here? There are not many entries. So we have one of it is sell of what we call delivery van proceed. Sale of the delivery van's proceed. Sale of what we call the delivery van proceeds. Sale of what we call delivery van proceeds. Sale of what we call the delivery van proceed. Sale of the delivery van proceed. So that should be 1.4. So then that is the non-taxable income. Then we have allowable expense that was not included. That is what we call investment allowance. Investment allowances. So the investment allowances, that should be 380. So that is less. What are we lessing? That should be 1780. So this is the figure. Get for me items that we're adding back. Combine for me that. Combine for me that. Items that we need to add back. Get for me that figure. The items that we need to add back. 148, 150, 620, 225, 80, 140, 120, 150 to 10 to 50, 130 to 10, 130 to 10. Then somebody gets it at 2433. So we have a figure of 2433. So then we have adjusted, what we call adjusted. Adjusted, we call it the adjusted taxable profit. The adjusted taxable profit. The adjusted taxable profit. The adjusted taxable profit. So 1597 plus 2433 minus 1780. So what do we have as adjusted taxable profit? As the adjusted taxable profit. So we have 22, 2215, as the adjusted taxable profit, but not very important. I say that for learners, what is important, and I repeat it again, what is important is basically the entries altogether. What is very important is what we call the entries are what is very important altogether. If I'm a student, let's say, for example, I lack time. I have done this, I have this, I have this figure, or maybe I have these figures and I don't have time. What should I do? What should be of my priority? Between entry and addition, what should be a priority? What should be a priority should be the entries altogether. What should be a priority is the entries, not addition. So on this particular question, we are done. But what are the figures that amount to the marks? This 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we have 14 entries altogether. So just saying that any 14 times a half, that should give us 7. Any 14 times a half, that should give us 7. Are we together? So do you think if I do not get this figure, even if I do not get this figure, do you think I will still get everything? Yes, you still get everything. Yes, you still get everything. Even without this figure. Are we together? Even if you do this and put this figure and don't add, you will still have everything intact as 7. So that is done. So I want us to proceed. Is there any question? Is there any question pertaining to that? Is there any question? Is there any question? Then I want to teach something. You see, when you're doing a limited company, compared to what you call the partnership. So partnership, taxable investment income, we don't add them. However, for the limited company, you are able to note something when Malimo was when you are touching on this, we add the taxable investment income. Once we get the taxable adjusted business taxable income, we add the investment income that are subjected to tax. However, for the partnership, if we had, for example, dividends from cooperative society, we don't add it here, but we take it to where? We take it to the income allocation schedule. We take it to the income allocation schedule. We take it to the income allocation schedule. We don't add it back, but we take it to the income allocation schedule. But we take it to the income allocation schedule. Is that noted? So can I move to B? Yes, I can. Can I wrap this? Can I wrap this? If I can, then you give me yes. So then I'm being told, prepare allocation of the taxable profit. So that is what we call allocation of what we call the taxable profit. So allocation of the taxable profit. So on the allocation, we have partners, we have Mambo, we have Motor, we have Motor Car. And then we have the total. And then we have the total. So on this, do you have interest on partners? Do we have interest on partners? Interest on capital? Yes, we have. So interest on capital. Interest on capital. What is the interest on capital? That is for Mambo is 80. Motor is 140. Do we have for motor car? Do we have for motor car? Do we have for motor car? So we don't have. So what is the total? The total is to 20. The total is basically a figure of 220. Do you have any salaries to partners? Do we have salaries to partners? Do we have salaries to partners? Do we have bonuses to partners? Bonuses to partners, we don't have. Are we together? We don't have even an interest on draw. So we have what's called share of what you call profit or what you call loss. Share of profit or what you call loss. So this is adjusted business income or profit. So what is that adjusted business profit? By the look of things, you're giving me 2250. Guys gave me a figure of 2250. You gave me a figure of 2250 together. So this I call it B. I call it B. This I call A. So the share of profit or loss should be C, which should be B minus A. What is that figure? B minus A. B minus A. Should that be 2050? That should be 2030. Should that be 2030? 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 The difference, which is the share of profit or loss, what is the figure? Kindly. What is the figure? So 2030. How about I share? If I have Mambo, if I have Moto, and I have motor car. So Mambo, the ratio was a half times 2030. We have a quarter times 2030. And then we have a quarter times 2030. Give me the figures for this. So provide me the figure for that. So those should be the shares. So what is the half of 2030? Is that 10? Then the other one? What is a quarter? 507, 500. $507, 500. So what is it for mom? If you had that, that is 1095. This should be 647, 500. Is there any taxable investment income? Is there any taxable investment income? Do we have taxable investment income? Do we have taxable investment income? No. How many marks is that question? Two marks. So this any two times one that gives us. So in most cases, students, majority of the students, even if a question is easy, you'll find majority of the students still do not balance. So on the schedule, mostly the examiner always becomes very lenient. So if you had this and this, you put this, you still have your two marks. Because majority of the students will not get the correct answer. Majority of the students will basically not get the correct answer. So just by having this figure and this figure, for that 2 marks you have it. Is that question easier? That was a very light question to encourage us. Yes, to encourage us. Yes, to encourage us. That was basically to encourage us. That was to encourage us. I want us to begin a question in April 2024. April 2024. We have something on limited company. Question 4C. April 2023, question 4C. April 2024, question 3C. This is now a limited company. So that is April April 2020 for question, sorry, 2023. Question, April 2023. April 2023. That is particularly a very good question. A very good question. That was a good question, Zahari. A longer but a very good question. Zahari processes. That is April 2023, question 4C. Question 4C. Tuko sawa. That is now limited car. This is a question on limited car company. Now on limited company. Can I start the question? Are we there? April 2023. Can I start that question? Can I start the question? You're the guys to let me know. Do I start the question? Oh, where is Eva? I have not seen that. What if you don't? What if you indicate the figures, but you don't narrate what they are to do? What do you mean, Eva? Maybe let me unmute you to get you as perfect as possible. Kindly, I allow you. Don't be afraid. Ask. Ebu expound to me what you need narration, because I don't see narration in that figure, but you can explain to me what you mean by narration.
Good evening.
You can proceed. You are unmute. Eva?
I was referring to the
Proceed.
previous question we have done. Can you hear me?
What do you mean by narration?
I was referring to the question we have done.
Douglas, could you help Eva?
Yeah, I think she's speaking, but you can't hear her. I don't know why, but
Could
we
you-
can hear
could you
her from
help
our
Eva?
side. We can hear her, actually. We can hear her.
Let me check. Maybe my headphone. So, yes, you can proceed.
I was referring to the question we have done.
Eva?
Can you hear me? Let
What
me
is
just
wrong with
type.
my headphones? Can you begin? Yes, I think it's my headphone. Can you try again?
You can hear
I hope
us now.
it's now clearly.
Oh, you're talking about you don't say it narration to include, you don't say it interest on capital, you simply put the figures.
Yes.
You've not said interest on capital, you've not said share on profit, and you've not said
Yes.
Adjusted taxable business income. Is that what you mean,
Yes.
Eva?
Yes, yes.
Okay. The different types of a marker. But I would say, Eva, I'm saying the different kind of a marker are we together? What does
Yes.
those things symbolize altogether? When you just put figures without narration, that again, that is tricky. If it's a good marker, that should be wrong. Because what are they for? Are we together? If you don't say interest on capital, you simply put the figure. There are two possibilities. There could be a marker who's very fast and just give you that together. But again, the most important thing is to question, why would you put those figures? Those figures could have been copied. Are we together? That's something that raises alarm. that is something that raises the alarm. So narration is very important. It's very important. However, sometimes you can get a very linear marker and give you that, but essentially that should not be given. That should not be given. So can we start on April 2023? That is question 4C. That is now on a limited company. Can we start on that? We respond with a yes. We respond with a yes. Perfect. So then you're being told 𝐻𝐻𝐿 Processors Limited, 𝐻𝐻𝐿 Processors Limited presented the following statement of profit or loss for the year ended 31st December 2022. One of the things that I did say in this class, don't be obsessed with answers. Are we together? As a student, don't be obsessed with answers. One of the things that you should be obsessed about is the entries. Are we together? As a learner, answers should not be the main thing. Are we together? So then we're given a turnover. We are given a turnover. That should be a figure of 760,000. We have the cost of sales, a figure of 296,000, of course, rounded to thousands. Then we have what's called the gross profit. So the question is, we begin to define those income, whether they're taxable income or non-taxable income. So the first one is the gross profit. Is the gross profit taxable or non-taxable income? Is the gross profit taxable or non-taxable income? That is a taxable income. So then we are provided with other income. We are told that provision for foreign exchange gain. Provision for foreign exchange gain. When you talk about provision for foreign exchange gain, how do we treat the provision for foreign exchange gain? Provision is the same as unrealized together. So provision for foreign exchange gain, that is non-taxable income. Then we have what we call gain on the sale of motor vehicle. 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 Yes, gain on the sale of motor vehicle. That should be non-taxable. The next is what we call release of liability. Release of liability. Release of liability. How do you treat release of liability? Release of a liability. How do you treat release of a liability? Release of liability. What do you say about release of liability? When you say release of liability, release of what we call liability, look up. If you have release of liability and there's no additional information, how would you treat it? Release of liability and there's not an additional information. Joya said non-taxable. It will be taxable. However, majority of the students normally forget. Are we together? If there's additional information, you have to counter-check the additional information. However, if you have release of liability and there's not an additional information, then basically we treat it as a taxable income, as a taxable income. Is that noted? We treat it as a taxable income. We treat it as what we call as a taxable income. So then we have what we call refund of excess duty, refund of what we call excess duty, refund of excess duty, a refund of excess duty, that is non-taxable income. Then we have what's called the investment income. Investment income. Investment income. Investment income. That's not a business. That is not a business. Are we together? That is not a business income. Income. Look at him. That is not a business income. So that is non-taxable. However, if it is an investment income, look up. If it is an investment income that is subjected to further taxation, after getting the business income, you add it back. on other incomes. Are we together? You add it back on what you call on other incomes. Is that noted? You add it back on what you call on other income. Together. We respond to the yes. Are we together? Then, most of the time, the particular questions that you're given, what they call investment income. You're given what's called the investment income, and there's no additional information to expound. Additional information to expound whether this investment income was, if that is in relation to dividends, whether it was qualifying or non-qualifying. How would you treat it? There's no additional explanation. Maybe it was dividends, they have not expounded whether it is qualifying or non-qualifying. How do you treat it? How would you treat it? Particular question where you have investment income, but there's no breakdown of that investment income. How would you treat it? How would you basically treat it? How would you treat the investment income? We will treat it as a taxable income. So once you less it, you'll add it again. You treat it as a taxable income. Once you less it, you will add it again. So that is sorted. Is that part one? Are we okay on that part one? Part one, we okay. On the incomes, yes, we are sorted. So we can do this until the profit, then we come back for additional information. So we go to the expenses. Under expenses as learners, we need to understand the concept of allowable and disallowable expense. So number one is purchase of what we call a trademark. How do you treat purchase of a trademark? Purchase of what we call a trademark. Purchase of a trademark, that is non-allowable. So the next we have design of a company's website. Design of a company's website. That is, what do you do in order to it? Yes, that's not allowable. How do you do to it? What do you do to it? We claim website, we claim what? Design of a company's website. We claim investment allowance. We claim investment allowance. So then we have what we call director's fee. Director's fee. Director's fee. That's allowable expense. What about donation to charitable institutions? Donation to charitable institution. Donation to charitable institutions, that should be allowable. Then you have the next, which is called the depreciation expense. Depreciation expense. Depreciation expense, that is non-allowable expense. We have what we call the marketing expense. Marketing expense. How do we treat the marketing expense? That should be allowable expense. We have management and professional fee. Management and what we call the professional fee. Management and professional fee, that is allowable expense. Then we have what we call the general expenses. General expenses. Is that allowable? Yes, that is allowable. Then legal cost. Most of the time in PFT, you will have what? Additional information. However, if there's no additional information, that would be allowable expense. Then we have what we call loan repayment. How do you treat loan repayment? We only allow loan repayment, Douglas. Interest on loan is what is allowable, but loan repayment is non-allowable. What you allow is the interest on loan, but not loan repayment. Then we have what we call allowance for doubtful debt. Allowance for doubtful debt. Allowance for doubtful debt. Allowance for doubtful debt. That's a provision, or that is not specific. That is not specific. That is already, that will treat as non-allowable. Then we have impairment loss of property. Impairment loss of the property. Impairment loss of the property. That should be non-allowable. So we have the total expenses giving us a figure of 120,386. So we have the net profit for the year being 527,614. So that is the profit that was basically ascertained by the accountants altogether. So as a tax person, you need to adjust. So we can have our break. A break of how many minutes? Break ya dakika ngapi? How many minutes break? So let it come. Let me know. How many minutes break? That's okay. Somebody asks me here, Apple for charitable organization, please expound. When you say charitable organization in all exams, I want you to mark this. Douglas, are you there? When they say donation to charitable organization, once they say charitable organization, that should be allowed. Douglas, is that noted in all the class members? When the examiner says charitable organization, that should be allowable. However, if an examiner says a children's home, are we together? That is more vague. But when an examiner says donation to children's or to charitable organization, then that should be allowed together. That should be allowed. Is that noted, Awiko, Anna, and the rest of the team? Is that noted? Perfect. So then we can start that question now. We can move to the additional information. So on 1st April, the company acquired the following. So number one is the factory building. We claim investment allowance. We don't add it back because it's not included in the P&L, but we claim investment allowance. We claim investment allowance altogether. We basically claim investment allowance. Factory building, we claim investment allowance at what rate? At what rate? At what rate do we claim investment allowance? At 50%. What about warehouse? Warehouse at 10%. Warehouse, that should be 10%. Then we have lorry, a processing machine, 50%. We have lorry. We don't restrict lorry. Lorry should be 5%. Then the drainage system, that should be 50%. Then you have saloon car. Saloon car, two things that you need to know about saloon car. Yes, it's 25%, but then you need to understand that you do what, Eva? If the value is more than 3 million, you restrict to 3 million. Are you going to restrict in this case, Eva? Yes, you are going to restrict. Yes, you are going to restrict. Yes, you are definitely going to restrict. In that case, you are going to restrict. Yes, you are going to restrict altogether. You are going to basically restrict. Yes, you are definitely going to restrict altogether. So then the examiner tells us we have management. We have the next call. Management and professional fee comprise of the following. Number one, we have what we call development of strategic plan. Development. Umefloat wapi? Anna, umefloat wapi? Anna, where are you floating? Where are you floating? Anna, you're saying something on investment allowance. So we think that for saloon cars and SUVs, have we gone through the video for investment allowance in the notes? Investment allowance video in the notes. Have you gone through that, Anna? So we're saying that for saloon cars, particularly two things. For saloon cars, we say saloon cars and what we call SUVs. SUVs means sport utility vehicles altogether. SUVs basically means the sport utility vehicles altogether. SUVs basically means the sports utility vehicle. Yes, SUVs means sports utility vehicle. We can have Mercedes-Benz, BMW. If the value is more than 3 million, if the value is more than 3 million, if the value is more than 3 million, you restrict to 3 million. But go through that and out in the notes. Sawa Anna. Go through that in the handout. Then that will be okay. So then we go to management of professional fee comprised. I didn't want to leave this question. I want us to finish this question. Tafadhali, we are not leaving without finishing this question. Are we in agreement? We are not leaving here without finishing this question. I don't want to hold it. Are we in agreement? We have to finish this. So then we are saying that management of professional fee comprised of the following. Number one is development of strategic plan. Development of strategic plan. Is that allowable or non-allowable? Development of strategic plan. That's allowable. What about tax consultancy fee? Tax consultancy? That is non-allowable. That should be non-allowable. Tax consultancy. That should be non-allowable. Note that that is non-allowable. Tax consultancy, that should basically be non-allowable. That should be non-allowable. So then we have the next, what we call audit. Audit fee. Audit fee. That's allowable. Then you have environmental assessment fee. Environmental assessment fee. Environmental assessment fee. That is allowable. So then we move to the next. We have what we call general expenses comprised of the following. So we have installation of neon sign, installation of neon, expenses related to tax. Expenses related to tax. I was saying expenses related to tax. Nani mtu anauliza kwa nini? Expenses related to tax, for example, tax consultancy, those are non-allowable. Sawa. Somebody asked expenses related to tax, those are non-allowable. Together, expenses related to tax, those should be non-allowable. Together, team. Are we together? We respond with a yes. So then we are being told the next is what we call installation of what we call the neon sign. That's non-allowable. That's a capital expenditure. We claim investment allowance. So then we have car grant to the director. Car grant to a director. That's non-allowable. When a car grant is given to a director, then that should be non-allowable. When a car grant is given to the director, then that should be non-allowable. Then we have the next, what's called installation of what we call the processing machinery. Installation of what we call the processing machinery. Installation of the processing machinery. Non-allowable. We are going to claim investment allowance. We are going to add it to the value of the processing machine. Then we claim what we call investment allowance. We are going to add it to the value of what we call the value of the processing machine. Then we claim what we call investment allowance. So the next we have what we call the staff Christmas party. We have the staff Christmas party that should be allowed. Then retrenchment cost. Retrenchment cost. Retrenchment. How do you treat retrenchment? How do you treat retrenchment cost? If you give somebody because of redundancy, they cannot perform, would that be allowable expense? Would that be an allowable expense? If it is for redundancy, would that be allowable expense? So retrenchment, these are payments, for example, as a result of redundancy or reorganization. Are we together? But ultimately, when the examiner says redundancy, then in that case, report, are we together? When the examiner talks about redundancy, then that would automatically be non-allowable. Are we together? That would automatically be non-allowable. non-allowable. Would that be treated as a business expense? That would be non-allowable. So for this particular question, this basically we treat it as non-allowable. We assume it's redundancy. We take it as redundancy because normally when you talk about retrenchment, most of the cases is a result of redundancy altogether. Most of the time, it's always as a result of redundancy. So we treat that as non-allowable. Sawa. Are we together? We treat that as non-allowable. We respond with a yes if you're together. We respond with a yes. Perfect. So then we're being told that we're being told that legal fee comprises of the following. So one of it is defense against claim of breach of trade agreements. Defense against claim of breach of trade agreements. Defense against claim of breach of trade agreements. Why is it unallowable? If we look at that very key, that should be allowed. That should be, those are claims, that should be allowable. That should be allowable. Together, is that noted? That should be allowable. That should be allowable. Together. Are we together? Team, tuko pamoja. Team, are we together? Yes, perfect. Let me just send a link to some student here. Then we get back. I send a link to a student. Let me send a link. So back. So that will treat as allowable together. That will treat as allowable. Then we have the next. We are talking about the next is what's called renewal of Kenya Association member, Kenya Association of Manufacturers membership. Renewal of Kenya Association of Members, Kenya Association of Manufacturers, that should be allowable. Then we have legal fee that we incur to negotiate a bank loan. Is that allowable? Legal fee, that should be non-allowable. Thank you, Zipporah. That should be non-allowable. Then we have preparation of what we call employment contract. When you have legal costs for preparing an employment contract, are those allowable or non-allowable? That should be allowable. That should be allowable. Negotiating a bank loan is non-allowable, but preparation of staff contracts or the employment contracts, those are allowable. Then drafting a lease, and the figure is 60 years. Drafting a lease that is 60 years, then that should be, it is less than 99, then that should be allowable. Then finally, we are told that the release of liability was in respect of a loan obtained from one of the director who decided to write off the loan as it was due for over 4 years. In this scenario, how do we go about it? In this scenario, how would you treat the release of liability? How would you treat the release of liability? That was not an expense. That's non-taxable. That was not an expense, but that was an expense. In this scenario, we treat it as a non-taxable income. Are we sorted? Are we satisfactorily sorted? Are we sorted? Tuko sawa. So I want us to do investment allowance. We just have a summary. Can we separate it or have a summary for the investment allowance? Let's just have a summary for the investment allowance. Is that true? Let's have a summary, or we do 50 alone, a summary. Let's just have a summary. So we do investment allowances, nature of what we call the item, qualifying amount, we have the rate, and then you have the investment. We don't need residual because we're not moving to the next year. Do we need residual? I'm increasing. Do we need the residual? We don't need the residuals because it is not running for 2 years. So we come to this. We started the factory building. Amount is how much? The amount is 28. What is the rate? 50%. So what is the investment allowance? Let me have them there. We have warehouse. We have summary. Warehouse is that is 16. Then we have what we call, we had installation of processing machine. Installation. Installation of what we call the processing machine. Just a minute as so we are back. We can proceed. We can proceed. So then we have installation of the processing machinery that is also at 50%. At 50%, we get the other items. The other items we go to design of website. So we have the design of what we call website. The design for website. So design for website was a figure of 12. What is the rate for the design for the website? What is the rate for the design for the website? What is the rate for the design for the website, team? The rate for the design for the website. Eva, the rate for the design for the website. No. Websites, that should be 25%. Website should be 25%. If I hope that is noted, website should be 25%. Website should be 25%. Is that noted, Ivan? Yes. So we add also items here. We had a lorry. We have a lorry. Lorry is a figure of 35. What is the rate for lorry? All motor vehicles. What is the rate for lorry? What is the rate for the lorry? 25%. 25%. We have the next, which is called the drainage. Drainage. What is the rate for the drainage? The rate for the drainage. Drainage, this is, remember, manufacturing, Zohari processes. So the drainage is, what is the rate for the drainages? Drainage. The rate for the drainage, that should be 50%. Thank you so much. So then you have the next, what it calls saloon car. And Anna, this is where you need to take note. For the saloon car, we basically say this is restricted. For the saloon cars and SUV, this is restricted. If the value is more than 3 million, you restrict to 3 million. You restrict to 3 million. And what will be the rate? The rate should be 25%. 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 But there's an item that we have not added. There's an item that we've basically not added. There's an item that we've not basically added. There's an item that we've not basically added. We have neon sign. Neon sign. So what is the figure for the neon sign, Tim? The figure for the neon sign. The figure for the neon sign. What is the figure for the neon sign? The figure is 820. What is the rate for the neon sign? What is the rate for the neon sign? The rate should be 10%. So I want you to provide me. Remember, you're my team, and I cannot do this thing without you guys. So what is 50% of the figure that we have? So now proceed to give me this figure that we have. So we have 14,400. The next one, warehouse, that should be 280. This should be 8,000. Processing, this should be, what is the figure for this? Is it 780? That should be, I think, 780. 25% of 12,400. 25% of 12,400. 25% of the 12,500. So we have that as 3,100. What about 25% of 3,500? 12% of 3,500. So we have it as 875. 875. What about the drainage? 50% of that. That should be 1,300. 25% of this, that should be 750. Then 10% of 820. That should be 82. So we have our summary for the investment allowance. What is the summary for the investment allowance? Summary for the investment allowance. Summary for the investment allowance. We don't claim investment allowance on the trademark. That is non-allowable, but we don't claim for the trademark. We don't claim that for the trademark. The part of we don't claim investment, that's an allowable expense, but you don't claim the investment allowance for the trademark. Together, for the trademark, don't claim that. So what is the figure? So we have a total figure of 29, and guys say 569. We have it as 569 for the summary of what we call the investment allowance. This is for the summary. By any chance, do you have any items that have not been included? Look there very keenly. Do you have any item that has not been included? Do we have any item that has not been included? Do we have any item that by chance that we have not added to that? I don't think so. I think we have it all together. There's not any item. So the figure that we have for that summary, hold it somewhere. That figure, hold it somewhere. Are we together? The figure, hold it somewhere. Perfect, team. If the figure is held somewhere. So then you proceed and now start on that question. And I'll begin on the question. So the examiner tells us in this particular question, and I say the role of the student is not to get, is not to struggle to get the answer. But as much as possible, your goal should be to make as many entries as possible. So that is the taxable profit or loss for the 𝐅𝐎𝐂 Limited. Taxable, compute the taxable profit. So we call it the 𝐅𝐎𝐂. We call it the 𝐅𝐎𝐂 Limited. Processors Limited. And we call it the taxable. Taxable, we call it taxable. Taxable profit or loss. Profit or loss. That is for, we call it for 2022. For 2022. So then we have our figures here. Which method do we apply? And which method do we apply to get the taxable income? Which method do we basically apply to get the taxable income? Which method do we apply? So the net profit method. So what are we going to say? We are going to say net profit. We call it the net profit. We call it provided. The net profit provided. And the net profit that is provided, that should be 527,614. And they say add back. We say add back. And what are we adding back? We're adding back non-allowable expenses in P&L, and what we call the taxable income, not in what we call not in the P&L. And I say in the exam, don't write this, or you just write add back. So we go to the expenses, we have what we call the purchase of what we call a trademark. Purchase of a trademark. What is the figure for the purchase of a trademark? That is 48,800. You make sure you tell me the 48. Is that 48,400? So then we have design, what we call design of what we call a company's website. Design of what we call a company's website. Design of a company's website. And the figure is 12,400. We responded yes, the figure is 12,400. If you're moving on well, we respond. Please don't fail to respond. So we have the deposition expenses. We have the deposition expenses. We have the deposition expenses. So what is the deposition expense? We have it as 32,400. We have a loan repayment on that loan repayment. What is the figure for the loan repayment? So that should be 26 for the loan repayment. Then we have allowance for doubtful debt. So this is the provision allowance for what we call for doubtful debt. So what is the figure for the allowance for the doubtful debt? Allowance for the doubtful debt. Give me the figure for the allowance for the doubtful debt. Allowance for doubtful debt, what is the figure? So that should be 22. We have it as 2250. So then we have what we call the impairment. We have what we call impairment loss. So the impairment loss in this particular question is 1,500. So we step to the additional information. And I want to post this to one of my students, Davis. Am I going to have the figures that are in additional information one? Davis, am I going to add the figures that are basically in the additional information one? Davis, am I going to add the figures? No, because they're not in the P&L. They're not in the P&L. So we simply, as we took them to calculate the investment allowance, That's what we were supposed to do. But then we move to this, we have what's called tax consultancy. Tax consultancy. Tax consultancy. What is the figure for that called tax consultancy? That was a figure of 208. So then we have what's called, the next is installation. Installation of what we call of the neon sign. Installation of the neon sign. That was 820. Then we have what we call installation. We have car grant to director. Car grant to what we call to director. The car grant to the director. So the figure for the car grant to the director, that is a figure of 2,800. That is a figure of 2,800. We have the next that we had, installation of processing machine. It was also included. Installation of what we call of the processing machine. What is the figure for the installation of the processing machine? The figure for the installation of the processing machine. Installation for the processing machine. Installation for the processing machine. So that is 1560. Thank you so much. So then we have the next. We have the retrenchment. We say retrenchment. However, this must be clear. However, this must definitely be clear in an exam. If you have an exam, it's not just about putting it, it must be very clear. When you have retrenchment on issues to do with redundancy, then that is non-allowable. That's why we add it back. Together either. On issues to do with redundancy, then that should be non-allowable. So then we proceed to the next. Defense against claim that is allowable. So we have negotiating. We have here negotiating. Negotiating. When you incur legal costs to negotiate what you call a bank loan, then that should be non-allowable to negotiate a bank loan. So what is the figure? Is it 1168? Is the figure 1168? Together, perfect, 1168. So again, as a student, what did I concentrate on? I will not add this. I'll simply just go to the last part. Then I say, what do we less? We less what? Non-taxable incomes. In P&L, we have what's called investment incomes. In P&L, and what's called allowable expenses, not in P&L, not in the P&L. For examination purpose, don't write the whole thing that I'm writing. You guys can just say less. Let me stretch the camera so that we can have the whole board to the end. So we can be back. So we look at the incomes and basically figure out those are investment income. So we have provision. One is what's called provision. We call it provision. Provision for what we call for foreign exchange gain. Provision for foreign exchange gain. What is the figure? Provision for foreign exchange gain. What is the figure for the provision? So that should be 84K. So we can have, so we have it as 84,000. Gain on sale of motor vehicle. We have gain on what we call on sale of motor vehicle. What is the gain on sale of motor vehicle? That should give me a figure of 28. Then we have release of liability. Release of liability. And particularly for this release of liability, it is subject to additional information. Why have we left it? It is subject to the additional information because the examiner basically tells us the release of liability was in respect of the loan obtained by one of the directors who decided to write off the loan as it was due for over 4 years. So that's why we left it. It's not related to this. is not a taxable income. So release of liability, that was a figure of 32. That was a figure of 32. We have the next, what we call refund of excess duty. We call it refund of what we call of excess duty. Refund of what's called the excess duty. So refund of excess duty, that should give us 16. Then we have what's called investment income. So the investment income is a figure of 24. Then we have investment allowances. What is the investment allowance? Provide for me the figure of investment allowance that we were able to calculate. Investment allowance, what is the figure for the investment allowance? So that was 29. We have 29,567. So get for me how much you need to add, the figures that you need to add. So then we have the adjusted, we call it business, the adjusted business profit. Get for me the adjusted business profit. So get for me those figures. Add is for 77. You say 77. Somebody says 77. 96. What about the less? The less items. The items that we need less. So this, you add this. What about the less? The items that we need less. I am banking on you guys. It is you people that I'm waiting for. So 213,567. 213,567. So what is adjusted business profit? What is adjusted business profit? The adjusted business profit. So provide for me that they adjusted. So this plus this, then you less 213. What do we have? And our goal is not to get the answer. Our goal is not on the answer. Our goal is not particularly on the answer. Douglas, this add to this, then you less 213. So that should be 431. You have it as 431, 973. I know some other guys want to confirm it. Then you add what's called add investment income. So the goal is to get the business profitable. So the investment income, what is the figure for the investment income? Investment income. The investment income is 24. So down here we have what's called total taxable. Total taxable income. So are we getting the same thing? My goal is not on the answer, but my goal is particularly on these entries. So when you add the investment income, is Douglas right? Why? To get the business. You see, investment is not a business. Are we together? Investment is not a business. Investment is not a business. Douglas, the essence of blessing it is to get a business income. Then you add those, look up, you add those investment incomes that are subjected to further taxation. Look at the question that you did pertaining to December, the December 2024. You remember that question? You remember that question? Douglas, I expect you to respond. I expect you to respond. So which is which? So what is this figure? Is this figure correct? I'm asking, is this figure correct? I am kindly requesting, is this figure correct? Which is not of essence. You know, the goal is not to get this figure. Is this figure correct? So this is Is this 213? Is the figure 213? Give me 213. So if that is 213, Eva, you get 391, 391, 391, 213, 567, 567. Eva, send for me that answer, 391. So down there, what is there? 391, 391. Eva, you have 391, 973, 973. So add the investment income. Yes. Add the investment income. Douglas, have you understood why I'm lessing the investment income? To get the business income. Douglas, do you have you gotten why I was lessing? So we have 415, 415, 973. Have they asked us for tax payable? Have they asked us for tax payable? The examiner has only asked for what? The examiner has only asked for total taxable profit or loss for the year ended 2022. Is that noted? So this is our summary. So what is our marking point? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 12, 13, 14, 15, 16, 17, 18, 19, 18, 19, 18, 19. So those are 18, 18. So the examiner needs what? What is the mark that is given? The mark is 12. So you look at this, we have 18 entries. You only need 12. Any 12, just say any 12 times a half. That should give us any 12 times a half. Any 12 times a half, that should give us, sorry, those are 18. Any 12, that should be any 12 times 1, 1. That should give us 12 marks for that. Any 12 times 1, that should give us 12 marks. Yes, you still have everything. To pass exam, it's not, you don't have to be the best. Douglas, do you believe that to pass exam, you have to be the best? No, 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 no. You can be so smart and just pass the exam. You don't have to be exceptional to pass exam. Are we in agreement? Yes, you don't have to be exceptional to pass exam. Are we together? You only need to be very smart. What I want you to train on as we end the class, what I want us to train on, I want you people to begin training on timing, how to time yourself. How do you manage time? Because when you're doing these things in class, it is completely a different ballgame. Because you have all the time, you can take time to answer, but when you're facing the exam, now you are racing against the clock. So it's very important that right now you begin to have these questions. You try them. If a question is 12 marks and you're supposed to do it in 36, that's probably a half. Take only 18 minutes. See how fast you are, See how fast you can do those questions. So I think from here, we're going to go to VAT revision. But for Monday, I want to discuss public finance. That is procurement in public sector and PPP, public-private partnership. That is what I want to discuss on a Monday. So on a Monday, I'm not calculating, but I want to discuss public finance. That is on a Monday tomorrow at 1. I want to discuss what we call the procurement in public sector, but at the same time, I also want to discuss PPP. I want to discuss public-private partnership. That is what I want to do on a Monday. Is that noted? So as you prepare for Monday, I have already given you what I want to discuss. And as we discuss, we also solve the problem. We discuss and also tackle questions pertaining to those areas. I want to say that God bless you and God bless our class. Our class is ended. Is that okay? Is there anybody with a question? Jaffa, give me a call. I want to talk to you. You give me a call, Jaffa. Jaffa, you give me a call. Thank you. No, we should be ready. Douglas, we should be ready. Now we should be ready. Is there anything tricky here? There's nothing tricky for this. In exam, there's nothing tricky. You only need to follow instruction. And once you revise very well, then that should be it. Yes. Thank you, Douglas. Thank you, Galma.
which is maybe to save the company from the financial problem it is what it is facing. On the other hand, we said the debenture holders, assuming the company had issued debenture holders, the company can enter into an agreement with the debenture holders, whereby the debenture holders will accept to convert their debentures or their debt into what? Into equity, or basically into ordinary shares. Now, all those are good examples of the compromise, or basically scheme of arrangement, which we said is arrangement, or the arrangement, or basically meant to do what? To save the company, which is meant to do what? To save the company. So therefore, we can say that this is any agreement, agreement between company and its members, all creditors, which is intended to do what? To save the company, from liquidation, to save the company from what? From liquidation. So this agreement, this arrangement is made between the company and the members, or basically creditors, in order to save the company from what? From liquidation. In this case, you can proceed and you give examples of this, and you can say examples include number one, preference shareholders, may enter into an agreement, into an agreement with the company, to reduce the rate of preference dividends, dividends. So these are good examples. The preference shareholders may enter into an agreement with the company to reduce the rate of what? Preference dividends. Number two, we can also say that the debenture holders, may agree with the company, to do what? To convert their debt, into equity, into what? Into equity. So when we talk about converting the debt into equity, this whereby, for example, if you have invested in a company in terms of buying debentures, so the company can basically request you, or can request now all the debenture holders to accept their debentures be converted into what? Into equity. Equity, remember, are ordinary shares. So mean that once the company has converted those particular debentures into ordinary shares, number one, the company will not be having an obligation to pay interest. And number two, the company will not be required to redeem maybe those particular debentures. Those particular debentures, once they do what? They mature. And also, we also need to recall that the dividends which are payable to the ordinary shareholders, those particular dividends are not mandatory. It's not a must that the company has to pay dividends to the ordinary shareholders. So the company will only pay dividends to the ordinary shareholders if the company is basically performing what? Performing well. So these are basically good examples of what we call as a scheme of arrangement, or basically what? A compromise. Now, I think what I was to give here are basically the steps which are involved. Steps involved in a compromise. Or basically in a scheme of what? Of arrangement. A scheme of what? arrangement. So for this particular scheme of arrangement to be implemented, so which steps need to be followed? So the number of steps, number one, or basically here the company will be required to call a meeting of the members or basically creditors. So if the company wants to negotiate, maybe the debenture holders, by requesting them to accept their debentures to be converted into ordinary shares, the company will have to convene a meeting of the debenture holders. Remember, debenture holders are creditors to the company. If the company wants to negotiate with the preference shareholders to accept a reduction in the rate of preference dividend, so the company will be required to convene a meeting of who? Of the preference shareholders. And actually, preference shareholders, these are members of who? Of the company. So the step number one is basically calling of a meeting, of members, or basically who? Creditors. So the company here will be required to call a meeting of the members, a meeting of the creditors the company wants to negotiate with, and basically enter into this particular compromise, or basically enter into this particular arrangement. Number two is that the company then will be required to issue. Step two is issue of explanatory statement. The company will be required to issue explanatory statement. So when we talk about explanatory statement, this is basically like a statement issued by the company, regarding the proposed scheme, or basically the proposed arrangement. What is the arrangement of the company? What is the arrangement of the company? Well, basically, what is the company proposing? If, for example, the company is proposing to convert maybe the debt or the debentures into ordinary shares, that information must be very, very clear in this particular statement. And actually, this statement has to be made public, and also it has to accompany those particular notices, which are sent to the members or basically creditors regarding that meeting. So if the company is proposing to reduce the rate of preference dividend, also that must be included in what? That must be included in something called the explanatory statement. So once that has been done, the explanatory statement has been issued. Step number three is that the company will need to obtain a court order approving this particular arrangement here. So we say that a court order must be obtained by the company, approving the proposed scheme. That is approving the proposed scheme. So the company here will be required to obtain a court order, which is basically approving this particular proposed scheme, or basically proposed compromise. Compromise. And then from there, and there is something basically I forgot here. Once this particular meeting of members and creditors has been held, so the members who are being affected by this scheme, the creditors who are being affected by this scheme, basically will be required to discuss the proposed scheme, will be required to discuss the proposed scheme, and basically they must approve it through a special resolution. So if the company is proposing, for example, to reduce the rate of preference dividends, say from 15% to 5%, during this particular meeting of the preference shareholders, that particular proposal by the company will have to be discussed, and basically it must be approved by the preference shareholders, or basically by super majority of the preference shareholders. Super majority is basically not less than 75%, or basically not less than 3/4 of basically the members holding the preference shares. And finally, the last step, basically, which is step number 4. Step number 4 is basically registration of the compromise. Number 4, registration of the compromise. registration of the compromise, registration of the compromise with the registrar of companies, registration of the compromise with who? With the registrar of companies, with the registrar of who? Of companies, with the registrar of companies. So therefore, those are basically the steps which are followed for this particular scheme of arrangement, or basically for this compromise to be what? To be implemented. To be what? To be implemented. So I think that is it. That basically what was required as far as that question here is basically what is concerned. Yes, so I want us to basically move to the other questions here. To the other question, and can someone share that? I can't see my mock paper. Can someone share? Walter, can you share that paper in the class WhatsApp group? Yes, can you reshare? Can you reshare? Can you reshare that paper in the class WhatsApp group? Someone to reshare, someone to reshare, someone to reshare. Someone to reshare, someone to reshare. I can't see that paper. I don't know what happened with my phone. Okay, thank you. Yes, so let's basically move to the other questions here. So it basically means that we have answered question number 5. I think as far as question number, okay, let's move to question number 6. Question number 6 here. And question number 6, we are told part A, highlight 3 ways through which an auditor may be appointed. Through ways through which an auditor may be appointed. Basically, first of all, who is an auditor? An auditor, we said, is an independent person who is basically appointed, or is we can say is an expert, is a professional who is basically appointed in order to independently examine the financial statements of the company, and basically be able to do what? Be able to express an opinion. Be able to do what? To express an opinion. So what the question was asking here is basically, how is the auditor appointed? Question number 6. 6A, ways of appointing an auditor. Ways of appointing an auditor. So the auditor, basically, if you can be able to remember our discussion in class, we said there are 4 ways through which the auditor may be appointed, actually not 3. So one is, we talked about appointment. We talked about appointment by who? By the shareholders. By the shareholders, or basically the members of the company. And actually, we said the members of the company do have the right to appoint the auditor during the AGM. So once the company has convened an AGM, we said one of the ordinary business, or one of the business which is transacted during the AGM, is basically the appointment of the auditor. So the members have the right to appoint the auditor during the AGM, AGM. And actually, we say the auditor who is appointed by the shareholders is supposed to hold office from the conclusion of that AGM until the next AGM. So in the next AGM, this auditor shall be regarded to be a retiring auditor, unless maybe appointed back. So number 2, we talked about appointment by directors. Appointment by directors, or basically the board of directors. Now, in this case, we say that the board of directors basically can appoint the auditor in 2 circumstances. One is in case of what? In case of a casual vacancy. Casual vacancy basically means that maybe the auditor was appointed by the shareholders, for example, has vacated the office, maybe due to resignation, due to death, or something like that. So in case there is a casual vacancy, that cash flow vacancy is supposed to be filled by who? By the board of directors, or basically by the directors. Number two, we said the directors have the powers to, or they should appoint the first auditor. The first auditor. So the first auditor of the company, this is the auditor of a newly registered company. And the auditor of a newly registered company is always supposed to be appointed by the directors, or even or actually the board of directors. Number three, we talked about the appointment of the auditor, appointment by the cabinet secretary, appointment by the cabinet secretary. Remember, you said as per the repealed Companies Act, in case the shareholders didn't, or the members didn't manage to appoint an auditor during the AGM. Previously, we said the auditor was supposed to be appointed by who? The Register of Companies. But as per the new Companies Act of 2015, in case the shareholders of the company have not agreed on the person to be appointed as an auditor during the AGM, it is, or basically the directors of that company should basically go ahead and inform the cabinet secretary. And actually, this should be the cabinet secretary in charge of the docket, in charge of the ministry under which the companies operate. I said currently companies, most, or actually companies operate under this ministry. We have this Ministry of Investment, Trade, or something, Ministry of what? Investment, Trade, and I think something else. So this is the cabinet secretary who must be informed by the directors, and then in consultation with the directors, he will go ahead and basically do what? Appoint the auditor. In consultation with the directors, he will go ahead and appoint who? The auditor of the company. Also, we talked about the other way through which the auditor may be appointed, and that is something called automatic reappointment. Automatic what? Reappointment. So when talk about automatic reappointment, this whereby the auditor who was appointed in the previous AGM shall be regarded to be automatically reappointed back in the office. Or actually, we say that the retiring auditor, remember the retiring auditor, an auditor does not retire because of age. Or basically, when you refer to the retiring auditor, an auditor once appointed in a certain AGM, in the forthcoming AGM, he's regarded to be a retiring auditor, because once you are appointed as an auditor, you should serve the company from the conclusion of that AGM where you are appointed until the next AGM. In the next AGM, you are regarded to be a retiring auditor. So, but you said that retiring auditor shall be deemed to be automatically appointed back in the office unless, number one, a resolution has been passed appointing someone else, appointing someone else as an auditor. Number two, that auditor is not basically willing to, or has given a notice about his unwillingness to continue serving what? And that particular company, or maybe a resolution has basically been passed by the members removing him from what? From the office. So therefore, this basically we said are the various ways through which now an auditor may be appointed. An auditor may be what? Appointed. Remember, as far as the auditor is concerned, we talked about so many issues, including the qualification. We said, for example, for you to qualify to be appointed as an auditor of the company, one, you must be a holder of a practicing certificate, which is issued to you by 𝐼𝐍𝐹 pursuant to the Accountant Act. And we said for you to be issued with that certificate, practicing certificate, one, you must be a CPA finalist or maybe a CCA finalist. Number two, we said you must be a registered member of 𝐼𝐍𝐹, a registered member of 𝐼𝐍𝐹. And number two, we say that you must be a holder of annual license. Annual what? License, which equally we said is issued by 𝐼𝐍𝐹. According to, or in accordance with the Accountants Act. So I think basically that is what was required there. Let's move to the other questions here. We move to the other question, here. And the question here was asking about about something we discussed, still in relation to what? In relation to the alternatives. So the question reads, explain 5 strategies that may be employed by the company against a hostile takeover. The strategies to be adopted by the company against the hostile what? Against the hostile takeover, the strategies adopted by the company against the hostile takeover. So first of all, you have to recall what do you mean by a takeover. Basically, a takeover, which is also known as the acquisition. We say that this is basically one of the alternatives to the liquidation of the company. If the company has been making losses, or basically a company has been struggling financially, now instead of liquidating that company, we say that there are various alternatives. One of which is basically takeover or basically acquisition. We also talked about merger or amalgamation. We talked about external reconstruction. We talked about the internal reconstruction of basically the capital reduction, and so on. So what the question was asking here are basically the strategies that the company may employ against a hostile takeover. Strategies to be employed by a company against a hostile takeover. Against a hostile takeover. A hostile takeover against a hostile what? A takeover against a hostile takeover. Remember what is a hostile takeover first of all. Even before I explain what is a hostile takeover, we said basically assuming we have company A, which want to take over company B. To take over, we said is to buy all the shares. To buy all what? The shares. Maybe company A want to buy all the shares in company B. This one is called a takeover, or basically is called what? An acquisition. So company A want to acquire company B. So we see this company here, which want to acquire all the shares in company B. This company we refer to it as the predator. We refer to them as to this company as what? As the predator. Well, as now this particular company here, company B, this company is basically known as the target company. The target what? The target company. So basically, we said for this takeover to be able to take to go through, this company, the predator must make a takeover bid. Must make a takeover bid. Must make a takeover bid. So what do you mean by a takeover bid? A takeover bid, basically, we said is an offer which is made by this company to acquire majority of the shares, or basically all the shares in company B. So once that takeover bid or that offer has been made, a bid is an offer. So this company will be making an offer. We want to buy all the shares from this company, and we are offering this particular amount of money. So that bid will be sent to the board of directors of this company. And we said once the directors receive this board, for it not even to be able to proceed to the other level, it must be approved by the board. It must be approved by the board of directors of this what? Company. But we said once the board of directors receive that offer, which has been made by the predator, they can do what? They can reject it. They can reject it. So if they reject that offer, this company here, that is the predator, may decide to use other channels, other means, by the end of the day to acquire majority of the shares or all the shares in the target company. Now that basically we refer to it as a hostile takeover. A hostile takeover is a type of a takeover whereby the predator will try to use other strategies. And I think we mentioned about those strategies. We talked about something called the proxy vote. And I think the proxy vote, there was another one, I can't be able to remember the exact name, which will be used by this particular company to do what? To acquire the shares directly from the shareholders of this company, whenever those particular shares are trading in the securities exchange market. So therefore, if this company still is trying to pursue a takeover which has already been rejected by the board of the target company, that one is called what? A hostile takeover. And I think we talked about the strategies which can be employed by this company to be able to acquire this target company, despite the offer which was made having been rejected by the board of directors. I think we talked about two strategies: the proxy vote, the proxy vote. When we talk about proxy vote, we said that this whereby this company, the predator, can basically approach the shareholders of the target company and try to convince them to remove those directors who are opposed to that takeover. Remove them, replace them with the new directors who will be able to approve that particular takeover. So we refer to that as the a proxy vote. There was another one whereby this company will offer to buy the shares basically at a premium directly from the shareholders. That strategy we are referring to it as what? That name is disappearing. What is the name given to that? The predator is offering to buy the shares directly from the shareholders at a premium. What is the name given to that strategy? Which is employed by this company? Who can be able to remember that name? Which was that name? That strategy. Mary, which strategy was that? I think that name is disappearing. There was a proxy vote. Yes, I think we will be able to remember as we move. So, but we talked about those particular two strategies which can be adopted by the predator, basically in order to do what? In order to acquire this company. But we say now, this company on its side can be able to employ a number of strategies to avoid a hotel takeover. So which are those strategies? We talked about, I think, 5 or 6 strategies to be adopted by the target company to avoid a hostile takeover. To avoid a hostile what? Takeover. I think one of it was known as the poison pill. Poison pill. Poison pill basically we say that this entails, or this basically involves, okay, yes, I'm told that one is called a tender offer. Yes, a tender offer. A tender offer. So this company, the predator, will offer to buy the shares of this company at a price above, or maybe at a price which is above the market price. Or basically they will offer to buy the shares at a premium, a price which is basically above the market price. So the strategies basically to be adopted by this company, one is a poison pill. Poison pill basically we say that this company, that is the target company, will make its shares unattractive. Make its shares what? Unattractive. Unattractive. And actually we said this company will make its shares unattractive, maybe by issuing additional shares to existing shareholders at a discount. At what? At a discount. So this company will make its shares unattractive basically by issuing additional shares to the existing shareholders basically at a discount. So by doing that, that company makes its shares what? Unattractive. Make its shares what? Unattractive. In other terms, we said poison pill. This whereby the company will take a poison basically for the predator to avoid it. So you see, if we have a predator which is basically want to eat maybe for example another animal. So if this animal, for example, take a poison, will the predator still pursue to eat that animal? Automatically no, because it has taken some poison. Yes. So then from there we also talked about number 2, we talked about something known as the crown jewel defense. The crown jewel defense. Crown jewel defense. We said that this basically entails selling the most valuable, selling the most profitable business of the company. So here the company will do what? The company basically will sell the most profitable business. So the target company sells the most valuable valuable, or basically the most what? Profitable business. And I think in this case, I gave a good example. If the target company is a company at Safaricom, they may decide to sell this product here. They may decide to sell M-Pesa because this is one of their most profitable business. They can decide to sell. Can we sell this this product because it is the one which give us a lot of money. So if they do that, then it will become unattractive, and the predator will decide, let's just do away with that particular effort we are making to do what, to acquire this company.
If you can hear me, then you respond with a yes. Good evening, Anne.